Why invest in stocks? We all work an entire trip to have some comfort. At all costs we can achieve a stable life. We get consumer goods like cars, a comfortable house, good appliances. When we are older, our income is diminished by retirement, our whole life can change all of a sudden. At this point, some expenses are maintained and others may even increase. We all need to have enough retirement income to pay bills for water, electricity, cable TV, medicines, health plans, food. In addition, everyone wants to have an income that provides fun, such as taking trips, going to restaurants, going out with friends. That's why it's important to save and invest your money every month to have a peaceful and comfortable retirement, where you can still enjoy your life with quality and fun. Investing in stocks only means buying small shares owned by a company. These small shares are known as company shares, and by investing in them, you expect the company to grow and perform well over time. If the company grows and performs well, your shares may become more valuable and other investors may be willing to buy them from you for more than what you paid for them. If that's the case, you'll make a profit by selling your shares in the future. Step 1. Open an account. One of the best ways for beginners to start investing in the stock market is to put money into an online investment account, which can then be used to invest in stocks or stock mutual funds. In many brokerage accounts, you can start investing for the price of just a single share. You need to choose between investing in funds or individual stocks. Stock mutual funds or exchange-traded funds. Mutual funds allow you to buy small pieces of many different stocks in a single transaction. Index funds and ETFs are a type of mutual fund that tracks an index. For example, a Standard & Poor's 500 fund replicates this index by buying the shares of its member companies. When you invest in a fund, you also own small stakes in each of these companies. You can put multiple funds together to build a diversified portfolio. Note that stock mutual funds are sometimes also called stock mutual funds. Individual shares. If you're after a specific company, you can buy a single share or a few shares as a way to dive into the waters of the stock market. Building a diversified portfolio of many individual stocks is possible, but requires significant investment. The advantage of stock mutual funds is that they are diversified in nature, which lowers risk. For the vast majority of investors, especially those who are investing their savings for retirement, a portfolio consisting primarily of mutual funds is the right choice. But mutual funds shouldn't skyrocket as some individual stocks might. The advantage of individual shares is that a wise choice can pay off a lot, but the chances that any individual share will make you rich are extremely small. How much money do I need to start investing in stocks? The amount of money you need to buy an individual stock depends on how expensive the stock is. Stock prices can range from just a few dollars to a few $1,000s. If you want mutual funds and have a small budget, an exchange-traded fund, ETF, may be your best bet. Mutual funds usually have a minimum of $1,000 or more, but ETFs trade as a share, meaning you buy them for the price of one share, in some cases, less than $100. How much money should I invest in stocks? If you are investing through funds, did we mention that this is the preference of most financial advisors? You can allocate quite a large part of your portfolio to equity funds, especially if you have a long-term horizon. A 30-year-old investing to retire may have 80% of his or her portfolio in stock funds, the rest would be in bond funds. Individual shares are another story. A general rule of thumb is to keep them in a small part of your investment portfolio. Get started soon. The sooner you start, the more time your money will have to grow. It is the power of interest over interest. If you manage to save and apply 10% of your income, That's a good start, but always try to save more and as soon as possible. So you will see the snowball effect. Only to know, a $10,000 investment in the S&P 500 index 50 years ago would be worth nearly $1.2 million today. It's amazing. Golden tips. Diversify your portfolio. Choose some sectors, at least 4, and distribute your contributions among them. Only invest in businesses you understand. Don't invest in complicated deals that you don't understand. The agriculture sector, for example, can be quite complex to understand when the company is doing good or bad. Avoid high volatility stocks until you get the hang of investing. Many stocks go up and down very quickly, which can hinder your understanding and analysis. Stocks in stronger companies are not as volatile. Always avoid very low price stocks. It is better to invest only in larger companies with less speculative valuations. Learn the basic metrics and concepts for evaluating stocks. Mainly the financial health metrics of companies, such as those that talk about indebtedness. You don't need to do extraordinary things to get extraordinary results. That's what our billionaire Warren Buffett preaches. The surest way to make money in the stock market is to buy shares in large companies at reasonable prices and hold them as long as the business stays good, or until you need the money. If you do, you will experience some volatility along the way, but over time you will produce excellent returns on your investment. Don't think you're smarter than others. No need to waste time trying to guess which is the best opportunity to buy stocks. If you do, you will likely buy shares in small companies that can make you lose. Focus on big, solid companies. Long-term security is what matters. Be consistent when buying stocks and save every month. Consistency will make a difference in the amount of value accumulated over the long term. Cut the high expenses that hinder your financial health. Expensive clothes, subscription services you don't use, overspending can boycott your retirement and future income. Set aside a chunk of money first, then think about your non-essential expenses later. The priority is to have your future guaranteed.